Good afternoon. Just a morning. See, I wanted to check if you guys were awake. Coffee? You like the cookies that we had? Good, good. Hey, you may be wondering, why am I carrying a bucket? What does a bucket has to do with financial planning or getting ahead financially? What do you think? And you see those buckets right here? Bucket list? Well, no, not quite. Look at that. We got 3 buckets. Now, the reason why I bring them is because I believe that everyone in this room has 3 buckets of money. 3 buckets of money. Now, some buckets may be bigger than others, right? But the first bucket that we have, all of us have, is probably what I call the pre-tax bucket. You know what I mean by that? Money that has not been taxed yet. How many here have a 401k? Okay, all of you. How about an IRA? That's where the bucket, this is the bucket. Now, who remembers the good old pensions that we used to have? Defined benefit pension. Remember those beautiful pensions? I mean, I love those pensions. I still have one from a very old company where they said to you, all you have to do is come to work for 20 years, right? You stayed with us for 20 years. You don't have to contribute a cent, not 1 cent. And by the time your 20th year comes up, you're going to get a lifetime income. What happened to that pension? It's gone. Now they have what they call a defined contribution plan, which is this, where you take all the risk. This is in the stock market for most people right here. And when the market goes up, you're happy. When the market goes down, people are sad. And you have no control over the growth of this bucket. You know, I was just reading today the USA Today newspaper. I love that newspaper. And right there in the money section, you can pick one up on the way. They're in the lobby. They say right here, Trump. You know the news, right? 2 people got in trouble. And they're thinking about impeaching him. And I'm going to read what he said. He says, I'll tell you what, if I ever get impeached, I think that the stock market would crash. You would see numbers that you wouldn't believe in reverse. I believe that. He'll get out of office. The market will crash. Do we have any control over this? Do we have any control over what happens in North Korea, maybe? The market, we're at the mercy of the market, right? But this is unfortunately the biggest bucket for most people. You agree with that? The second biggest bucket is this little white bucket right here. You have it probably. This is where your stocks, bonds, and mutual funds, besides being here, are here. This is where your homes fall into right here. This is your homes. That means that when you're selling your stocks or bonds or you're selling your personal residence, you're still going to be taxed, but better than this. This is what they call capital gains. This is what they call ordinary income. This could be as high as 37%. This is only 16%. But unfortunately, most people, their biggest bucket is what? This. And the third bucket, my favorite, right here. Most people don't even have this bucket. It's what they call the tax-free bucket. And this is where they become the banker strategy and the product falls into. Now, the wealthy have known about this bucket, and they made it their biggest bucket. Not this, but this. But for most of us, this is our smallest bucket, if we have it. So my job today is to let you know that it's not bad to have pre-tax money. It is not bad to have tax managed money. It is not bad if you don't have tax-free money. But you know what? My job is to help you level them out, make them balanced. Does that make sense? All right. So, what brought you here? Kind of curious.
My money.
Your money brought you here? All right. How's that? Now, really, what brought you here? You want to keep your money. Okay, what else?
Build money.
Build money, okay. What else?
I want to
Go ahead.
help my family.
You want to help your family. Very good. What else? Financial future, different strategy. You know, I like that. All of those answers are great. But this gentleman here hit it right there on the head. You see, traditional methods of financial planning are not working anymore. What used to work in the past is now working today. People made a lot of money in the stock market. That was in the past. They're not doing it today. So you have to think out of the box. You have to have different strategies to be able to get ahead. That's good. Anybody else?
You want to have your money work for you.
Good point. There's only two ways to make money, and I'll talk about that. One is you working for your money, and the other one is your money working for you. So we're going to teach you today how you can make your money work for you. Fair enough? All right. So let me show you what you're going to get. And they're distributing those packets right now. You're going to get a beautiful folder, and inside that folder you will have several things. The first thing I want you to look at when you get the folder is this sheet right here. It is called the Become the Banker Discovery Sheet. Okay? This is a sheet that I want you to complete before you leave today and give it to me or Randy or Christine, and this will allow us to set up an individual appointment with you to find out if the Become the Banker strategy is actually good for you. You know why? Because we talk about your retirement. We'll be talking about your money, and we don't want to talk about your money now in a public setting. We want to talk about your money in a private setting. Okay, so this is a free up, don't have to worry about paying anything. This will just allow us the opportunity to sit down with you and find out what retirement looks like for you. What is that? Where are you financially right now? Where you want to be in the future, and how we can help you get there with this strategy. But we just don't want to talk about this in public. Is that fair enough? So don't forget this, okay? Then the second thing you will get a stapled sheet like this. But you don't have to look at it right now. Just look at mine right here. It has my picture, and this is my profile with the Certified Financial Planning Board. And you can read about it. You will read an article of the Denver Business Journal called the 1929 Crash that we're going to be referring to, okay? And then the last thing I want you to look at is your workbook. We're going to make you not work, but you're going to be really excited to learn this concept. People love it, and the benefits are tremendous. When you leave today, I will guarantee you one thing. You will think about money in a different way. So you came in through those doors, and you're going to go out the same doors, but with a mindset that is totally different about money. All right, so take notes. I want you to take notes, underline, highlight, and what I want you to do is to open them to page number 6. Everybody got a pen? Good. Page number 6. All right. Everybody there? Page 6? You got it? Okay. Randy, please. Page number 6. And what I want you to do at the very beginning is to read with me the second paragraph on that page. Building wealth does not have to be complicated. Traditional methods of getting ahead financially are failing. Do you agree that we need to do something differently now? Just mark it down. So there's only 5 questions that I want you to write the answers to. You don't have to tell me out loud, just write them. Fair enough? Because we're going to go over them later. Number 1, when you're looking to borrow money, whether it's for a mortgage, credit card, anything, a car, what are you looking for? What do you want? Well, don't tell me, just write it. But you're right though, low interest, okay? You're on the right track. When you're looking to borrow money, what are you looking for? Number 2, when you're looking to make money, when you're looking at an investment, when you're looking at a savings account, what do you want? Number 3 is the $1 million question. How much money are you worth? Now, before you write it, I want you to understand the question. If you were to hire yourselves, if you were a company and you were to hire you, how much money would you pay yourselves? I want you to take whatever you're making a year or monthly and put down a percentage that you would be willing to pay yourselves.
So that's what
Be real.
we're worth. That's what you want us to put.
Yes, be real, okay? Be real. Because like the gentleman here in the front, he said that he wants to get out of this how to make his money work for him. However, though, why am I asking you to do this? Because see, we go to work every single day. We get paid, right? And then we pay everybody else first. Except who?
So before taxes or after taxes?
After taxes.
Okay.
Okay? Your net. So we pay everybody else first, am I right? Mm-hmm. Except who? So we become almost like economic slaves. We're working for nothing. So I want you to mark this down. Rule number 1 of the wealthy, they always pay themselves first. That's how they got ahead financially. They always paid themselves first. You know, let me just say this to you. We've been doing seminars like this for probably like 20 years. And we have met people that have made a tremendous amount of money. I mean, that make a lot of money. That have nothing to show for. Can you believe that? I mean, just recently we met husband and wife physicians. Both of them, doctors. They make over $500,000 a year. Over $30-some thousand a month. Yet, they have nothing to show for. Yet, guess what? We have met people. We met a house cleaner that came to a seminar like this in Centennial. And when we met with her with that form that I share with you, the discovery form, we found that she had over $75,000 in a liquid savings account. House cleaner. And I said, how did you accumulate this money? What do you do? She says, well, I clean homes. I don't own a company. I just clean homes. I'm an individual. I clean homes every single day. And I get paid every single day. And I decided many years ago that every Friday was going to be my payday. Is that brilliant? I said, was it difficult? Was it hard? She said, at the beginning it was. But now it's a habit. So how much money are you worth? Number 4, just fill in the blanks. Creating wealth. Creating wealth is not what you make I mean, underline that, highlight it, circle it. Most people get hung up on, I don't make enough money. That has nothing to do with creating wealth. Creating wealth is not what you're making, rather, it is what you're keeping, what you're saving. And this is music to this guy's ears right here. There's only two ways to make money. One way is for you to work for your money. The other way is to have your money work for you. And today you're going to be learning exactly how to do that. Is this exciting? All right, so let me turn the slides here. All those companies have something similar. I'm talking about Apple, FedEx, Uber, and Become the Banker, our company. The what? No, actually, they're disrupting the industries that they belong in. Now, think about it with me, please, because I'm going to teach you how to think differently about money. Apple disrupted what? The telecommunications industry, am I right? When they developed the iPhone. Remember, we used to have what? Landlines, phone booths, right? Pagers. Now, cell phones. Did they disrupt that industry? FedEx. What happened? What industry did they disrupt? Postal service and shipping by offering what? Overnight delivery. Uber and Lyft. Do you guys use it? I do. What a great company. I mean, were you aware that they're the largest taxi companies in the world? And they own no cars? How brilliant is that? They're the biggest taxi company in the world, and they have no ownership of any cars. Amazing. What did they disrupt? The taxi industry, the transportation industry, right? Become the Banker, we're doing the same thing. You see, a lot of financial planners out there, insurance people, stockbrokers, financial advisors, they're doing it the old-fashioned way. Become the Banker's taken over that. It's disrupting the financial planning industry. Talking about FedEx, by the way, FedEx spent over $1 million creating that logo. It's a beautiful logo, but they have two images embedded in that logo. They're subliminal, that most people, I would say 8 out of 10 people cannot see. But once I show them to you, you will see them forever. The first one is an arrow. Can you see an arrow? Raise your hand. Okay, better yet, people who cannot see it. Raise an. A lot. Watch this now. Pay attention. If I show it to you one time, you're going to see it forever. It's between the E and the X. You see that white? You see, somebody says, oh, hi, right? Now, from now on, when you see an envelope with a FedEx logo, you will see it. When you see a truck passing you by, FedEx truck, you will see it. When you see an employee with a uniform, with a logo, you will see it. How about the soup spoon? Can you see that? I mean, I'm talking about 8 out of 10 cannot see it. Oh, only 2 people? 3? Okay, 3. It's right here. But you'll see it from now on. Now, why am I sharing this with you? Because when people look at a dollar bill, it's like when they're looking at a FedEx logo without knowing of those images. When people look at a dollar bill right here, all they see is $1. They don't see what's behind the dollar. They don't see that 1/3 of this dollar, 1/3, goes to pay finance charges. Were you aware of that? For the average family, that is. 34.5% of every dollar we make goes to pay banks and credit card companies. You know how many items? On 3 items. 1 home, one car, and one credit card. Do you know somebody that has more than one credit card? Or two cars financed? I'm talking about just one of each. 1/3 goes to pay that. They also don't see that another third goes to pay, and I love this country, but goes to pay taxes. I'm not talking about just income tax, okay? By the way, I'm talking about all the taxes that we pay. Did you fill up your car today or yesterday? Did you pay taxes? Did you go out to eat? Did you pay taxes? When I called the Hampton Inn to reserve this beautiful room, they quoted me a price. When I leave today, guess what? It's going to be higher. So if you add up all those taxes that we're paying, 36% of every dollar we make goes to pay taxes. So if we're losing 34.5 to the banks and credit card companies, 36% to taxes, what do we have left? About 30 cents. That's right. That's why we have the worst savings rate in the world. You want to change that? You cannot eliminate not paying taxes. That's not what this meeting is all about. You cannot eliminate not paying finance charges. But what if this wonderful strategy, become the banker, could help you reduce that? Would you be better off? Okay. I want you to know the differences between financial advisors, okay, and financial planners and insurance people and brokers. I am a certified financial planner. And there's a big difference between financial advisors and certified financial planners. To get this degree, you have to go to college. And I went to the College for Financial Planning right here in Denver, Colorado. And I graduated actually in 1982. You have to get a master's degree in economics and finance to get this. And then you have to sit for an 8-hour, get this, an 8-hour exam that rivals the bar exam for a lawyer. 62% of the people who take that exam fail it. Those who pass it, they have to be under the supervision of a CFP for 2 years before they can let you use that designation. And that's when I said, when you saw the little stapled 3 sheets on your packet, you'll see that's my profile with a CFP board. So not everybody that calls themselves financial planners can help you to the extent that we can, okay? Our company is a family-owned company, Colorado company. 44 years now in business. And we're an A+ member of the Better Business Bureau. You can always check us out. And one of the best, I guess one of the most wonderful events in my life is that Fox 31 right here and Channel 2 have chosen me to become their financial expert, as well as Channel 9. I mean, they had actually thousands of people apply. And after going through their selection process, they chose me. Channel 9 just recently, by the way, but Channel 2 and Fox 31, how many of you have actually heard of the Problem Solvers? Okay, that's exactly where they use me. Okay, I go on their set once a month to answer questions from people like you, viewers. Channel 2 does the same thing, but that's on a different channel. And 9 News just began actually 2 months ago. They call me because they have a program now called Financial Friday every month. Financial Friday. And if you were watching Channel 9 on Friday that I was there last week, I was talking about the good, the bad, and the ugly of annuities. Now, nothing to do with Become the Banker because we're not promoting it. We're just helping people understand financial concepts. And of course, Tom Martino, like Paula mentioned, he's been my client for 20 years. He believes in the concept, and he's a watchdog. He's a consumer watchdog. How many of you know him or heard of him? So did you listen to his radio? Oh, okay, phenomenal. I mean, this guy has a lot of, he gets really uptight. If you go to his website, go to referrallist.com, you will see that he has a tab called the Sleaze Brigade. So when people don't behave, oh my gosh, you don't want to get into his bad side. All right. So this is my goals for you today. Since the wealthy always had a rule to pay themselves first, I'm going to motivate you to pay yourselves first today. If you don't do that, I'm going to tell you right now, you're wasting your time. Nothing will change. Everything will stay the same. Number 2, I'm going to show you how you can increase your money. Is that of interest to you? And number 3, how to reduce the risk of losing it and taxes. To me, that's pretty important. Because I wasn't born with a silver spoon, by the way. I was born from an economically disadvantaged family. Nobody gave me anything. So I know how important it is to keep my money safe. I don't want to go backwards. So we don't use the stock market. I detest the stock market because I've seen what has happened to people. So the only things that we do are safe money strategies, okay? All right. Don't mess that now. Did you mess it? You see the bags of money? And I want you to pay attention to this. Okay, watch again. It's real quick. There's going to be some bundles of money coming down. You see that? That's your money. Okay? Why do we have a cannon and a fort protecting your money? Why? Why do you think?
Everybody's trying to get it.
Who said that? Yeah. Oh, yeah, exactly. But let me ask you this. How many here in this room have actually heard of a person by the name of Willie Sutton? He's a real guy. Willie Sutton. Nobody here? Nobody's heard of him? Wow. I want you to write his name down and Google it. Not now, but Google it when you get off the seminar here. Willie Sutton, I'm going to show you his picture. He was the most famous bank robber in the world in the 1900s. I mean, it's almost hilarious. He used to rob a bank, get caught, put in jail, only to be let out of jail to do the same thing over and over and over and over again. I mean, he was the most successful bank robber in the world. And the media asked him, Willie, why do you keep robbing banks? You're going to find that quote on Google. He said, well, that's where they keep the money. Now, you see, even the law enforcement guy here is laughing. I mean, it was almost like a joke. Bankers used to think, if Willie Sutton doesn't come to my bank and rob us, there's something wrong with our bank. It was that way. I mean, look at it, read it. Well, Willie Sutton is dead. He's gone. He was a famous person in the 1900s. So you don't have to worry about him. But there are 4 Willie Suttons that we need to worry about. 4. That's why we have the fort and the cannon. The first Willie Sutton are the greedy bankers. Do you agree with that? How many of you have read or heard about what happened to Wells Fargo? Wells Fargo, recently. Have they learned their lesson yet? How many times have they violated so many things already, and they keep doing it? To the extent of what? Hurting their own customers. How wrong is that? By making you have fictitious accounts that you didn't apply for, so they can make commissions. Think about that. Greedy bankers. Number 2, like I said, I love this country. I defended this country during the Vietnam era. So I love this country. But I don't like taxes. That's another Willie Sutton right there. Taxation. Number 3, look at yourselves, please. Look in the mirror. You are another Willie Sutton. You're stealing from yourselves. Especially if you're not paying yourselves, right? That's what I told that couple, those doctors. I says, what's happening to this money that you're making, over $38,000 a month? It's just evaporating. We spend it. Are they hurting themselves? Yeah. And the last is Wall Street, right? So let's take a look at each one of them. Let's look at banks first.
Banks. Our deposits earn a measly 1% or less in a traditional bank, while they charge us between 6 and 30% when we borrow from them. This lopsided formula handicaps people from getting ahead financially. The average American family loses an average of 34.5% of every dollar earned in finance charges to this thief.
What a great business to be in. I mean, think about it. If I were to ask you to let me have your money, and I would give you 1% in return, but when you came to borrow from me, I would charge you 30. Would you think that's okay? But that's what we're doing, right? Banks. So I'm going to teach you right now something that's going to open up your eyes about how you think about money. What did you put down for question number 1 on page number 6? What is it? Who taught you that? No, really, who taught you that? Your family, school, right? Well, I'm going to tell you something right now that you've been taught wrong. We're always chasing what on a loan? The low interest rates, am I right? When the government reduced the rates on mortgages, what happened? Everybody refinanced, right? Because they were chasing the 3%. I'm going to show you today that that doesn't matter. The interest rate on a loan or a credit card does not matter. It is the volume of interest that you will pay over the life of the loan that really is the evil on borrowing money. Excuse me, let's take a look at that. This family had 3 items financed. 3. A car. What's the APR on the car? What's the interest rate on that loan? Can you see it? Okay. And I'm going to tell you right now, it doesn't matter. It could be 1%. Okay. How about the credit card? What's the interest rate on the credit card? And the mortgage? Okay. So let's look at the car. What is the monthly payment on that car? Okay, and what is the interest cost on that payment every month? So do you want to know exactly how much money you're really paying the bank? Take your calculators out, please, or your phones. Thank you, Randy. Just go to the calculator on your phone. And what I want you to do is to please divide the 175, which is the interest, monthly interest that the person is paying, into the payment of $594, and tell me what you get. How much?
0.29%.
Almost 30%. So, ladies and gentlemen, you're not paying 8.5. What are you paying? So I want you to start thinking about loans totally differently. I want you to start dividing the interest that you're paying on a monthly basis into the payment to find out really what the banks, what those thieves are charging you. Anybody here are you buying a home? Who's buying a home? Okay, so you probably understand what I'm talking about, right? If you take your closing documents when you bought the home, there's a page called the disclosure page, and it will show you how much money you will pay the bank if you keep their loans for 20 or 30 years. How much is that? And it doesn't matter what the interest rate is, you see. I really don't know what kind of math they're using. I mean, I really don't. So, if you buy this from a bank, and you keep the loan for 20 years, you will pay the bank for how much? Tell me, is that 6%? Is that 8? Is that 3? Is that 4? How did they come up with that? Isn't that amazing? So I want you to start thinking when you borrow money a little bit differently, okay? If you have to borrow money to buy something, wouldn't it be better to borrow from yourself and then pay yourself back? See, that's what become the banker will let you do. So, all right. The second thief, or the second Willie Sutton, is what? The government.
Our retirement plans are not safe. This thief can deplete our nest eggs through hefty taxation and can increase the tax rate at its own discretion at any time. Today, the average family loses an average of 36% of every dollar we earn in the form of income tax and all other taxes we pay daily: food, hotels, gas, etc.
Wow. 36% goes to pay taxes. And did you listen? They can increase those taxes at their own discretion. We have no control over that, do we? So when somebody says, you know what, when I retire, the tax tables are going to be low. How do you know that? More than likely they're going to be higher because of the debt of this country. Now, you cannot eliminate taxes, but would it be okay if we help you reduce them? That help you? So on the question number 2 on page number 6, what did you choose? What is the answer? Don't be shy now.
Probably wrong now.
Yeah, probably is. But go ahead, tell me what it is.
I put stability and 0% low interest rates.
Do you want to have low interest rate on an investment?
Oh, high investment, I'm sorry.
Oh,
investment.
okay, so you want to have a high rate of return. Now, who taught you that? See, everybody's chasing either the low interest rates on a loan, right? Or they're chasing what? The high returns on an investment. Just like the loan, I'm going to show you today that the rate of return on an investment is not that important. The thing that's more important is actually the way that that investment will be what? What would you say would be the best rate of return that you would like to get? The best rate of return. Let's dream. I'm not going to give it to you. Just dream. Who said that? 100%? 100%. All right. Let's play that game. 100%. Okay? 100%. Everybody agrees that that would be a great rate of return? Is there anything that can give you that right now? No. Okay? Who has a dollar bill? Is it that bad? Oh my gosh. No. I'll give it back. Well, come over here with me. We're going to play this game. Believe me, I'm not going to take it. I'm just going to play a game with you.
I get yours, I got 100%.
Come on.
Return.
Look, I'm going to show you something. I'm going to show you your name again?
Mark.
Mark, okay, Mark. Stand right here so we can see you. Mark heard me say that I could give somebody 100% rate of return. So in the year 2018, this year, he comes to me with $1. How many dollars must I give him for him to get 100% rate of return? Huh? $1? What do you mean? $2, right? So he gives me one. How many must I give him? 2. All right, so he likes that, right? That's 100% rate of return. Then he comes in next year, 2019, with $2. How many must I give Mark?
4.
Thank you. Let's make believe this is 4, Mark, okay? We're just playing a game. I know. Then in the year 2020, he comes with 4. How many must I give him?
8.
And then he comes with 8 the following year. How many must I give him?
16.
And then he comes the following year with 16. How many must I give him?
32.
And so on, right? Let's give him a hand, please. Thank you, Mark. Hey, would that be a wonderful rate of return? Tell me, what would be the value of his dollar bill if we keep playing this game every year for the next 20 years? You've probably seen it before. You just calculated it. Yeah, let me show you. He's right. Watch this. Over $1 million. A dollar bill turns into $1 million in 20 years. Check my math. It's all about math. But I want you to read what's on the white on the top. With no what? With no taxes. That's what it would be with no taxes. Now, do you want to see what happens when Uncle Sam begins to tax this wonderful rate of return? And I'm going to use a low tax bracket. I'm not going to use the highest. I'm going to use a low tax bracket. 17% tax bracket. Look what happens. And again, you can check my math. It's all about math. What happens if you're blessed and you make more money today and you are in a higher tax bracket than the 17%? I'm not going to use the highest, which is over 30. I'm going to use only 27%. Watch. So what good, please answer me this, what good is to get 100% rate of return? It's only a game. Wouldn't it be better to get a lower rate of return, totally tax-free? See, if you have an IRA right now, if you have a 401k or a SEP, that's the way you're going to be taxed right there on the right. I don't know about you, I want to retire here with no taxes. That's what I want to retire. A 401k, IRA, you're going to be paying taxes. And the government cannot wait to get their hands on your 401ks and IRAs. We have met so many people that are over the age of 70 and a half that don't want to take any money out from their IRAs or 401ks because they don't want to get taxed. And you know what? The government mandates that they take it out. If you're 70 and a half, you have to. It's called a mandatory distribution. And if you don't follow it, if you don't play their game, they'll penalize you 50%. Think about that. So what are they counting on? I mean, I get goosebumps talking about that because it is unfair. So how much money do we have left? I think we talked about that, right? But if there was a strategy that can help you reduce the finance charges and the taxes, and rather than staying here to live your life, you could be enjoying your life or retirement with that, would you be better off? Okay. So let's talk about the third thief, you and I. Okay. Have you ever wondered why some people succeed financially and other people fail? I mean, it became crystal clear to me when I came to this beautiful country at the age of 12. I mean, I understand that this is the land of opportunity. I mean, truly understand it. But I also saw people that were born in this beautiful country that don't make it financially. Then I see people that come from different parts of the world that make it financially. And I'm wondering why. Why is that phenomenon? So, in order for me to become a certified financial planner, I had to do a thesis, just like a master's degree. And I wanted to find the answer. And that's what led me to write my first book. It's called The Why Factor for Financial Success, to find out why. Why do people actually make it financially and other people fail? You know, I have seen all my children born. All of them. I went to that delivery room on each one of them. And I'm going to tell you something right now. The doctor did not say, well, that little boy, he's going to be poor. Or that girl that was born here is going to be really wealthy. No. So something happens to us between birth and retirement. Am I right? We're born the same way. So what is it? Well, I tell you what, I was actually doing my research for my thesis, and I came across this gentleman right here. Nothing to do with that disease, by the way. That's his name. He was a great economist in the 1900s. Great economist. And he had the same question. Why do people make it financially and other people fail? So he said, the number one key is that they procrastinate. Man, I tell you what, I'm seeing it with my own son. Although he works with me, he's 28, and I talked to him about being 65. He says, Dad, expenses rise to equal income. Sorry, I'm blocking you. Expenses rise to equal income. Have you ever put oil and water? What happens to the oil? It rises to the top, right? Expenses is just like the oil, rises to equal income. I mean, that was brilliant in the 1900s, and it still applies today. How many of you have gotten a tax refund? What happened to it? Okay, expenses rose to what? Equal income. What else? How about a pay raise? What happened to it? Expenses rise to equal income, right? So what you need to do is you need to start, putting some of that money away, right? Takes discipline. The third bullet says, living beyond our means. He said, in his own words, a luxury once enjoyed becomes a necessity. Brilliant. And I said, it applies to myself also, because 15 years ago I bought a car with heated car seats. Oh my gosh. I love that car. My wife doesn't let me buy another car without them, right? In the wintertime, phenomenal. Well, guess what? 3 years ago, I bought another car. But this car, in addition to having heated car seats, it has a heated steering wheel, and it has a heated console for your arms. And then it dawned on me. It just dawned on me that when I came from Mexico City to Greenfield, Iowa, in the middle of the winters, they're so humid, they're terrible. They're the worst winters you could possibly experience. We had no heated car seats, and we made it. My gosh, everybody wants everything, right? And we live beyond our means. If you go back to your parents' era or your grandparents, if they didn't have the money, did they buy things? Did they buy things? No. And if you go back to their time, they are probably better off than you and I. At least their home is paid for. That's the biggest asset they have. I've seen people in their 70s refinancing their homes. So what is the prescription? And you'll find out on the book. It's not what you make. Don't worry about that. Don't get hung up on, I don't make enough money. It doesn't matter. You got to keep a portion of it. Number 2, what is it? Pay yourselves first. If you don't do that, you're going to walk out of this room with the same mindset. And number 3, if you need to finance anything, become your own banker. And that's what you're going to be learning here in a few minutes. Is that exciting? Okay.
Building a comfortable retirement takes time and money. Meet two brothers. Ken started saving at age 30, $1,000 per year for 10 years. Bob waited till age 45 to save $1,000 per year for 20 years to make up for waiting. Let's see what happens. At age 65, Ken had $68,117, and Bob only had $38,993. He lost $29,124 by waiting. Don't be like Bob. Be like Ken.
Yeah. Even though he put twice the amount of money, he lost 10 years. And that enough, he'd lost almost $30,000. So don't wait. Take action. All right. The last, Willie Sutton, and you're going to have to definitely agree with me on this, is the stock market. After doing all my research, I can tell you that over the last 40 years, I have actually had a tremendous amount of knowledge of the stock market, and I have seen it go up and down. I have never seen the stock market like this for 40 years. Have you? So it's a gamble.
Wall Street. This thief has been made the center of attention as a fraud. Unpredictable stock market crashes, the mortgage collapse, and unethical brokers have been storylines for movies, such as The Big Short, Enron, and many more. The stock market is gambling. Would you take all of your retirement money to Las Vegas and gamble it away to this thief?
Would you? I mean, how many of you have gone to Las Vegas? I'm sure all of you, right? Let me ask you this. When you get off the plane, what do you hear? Okay. Okay. Have you ever seen the stock market opening on TV? What do you hear? I mean, I have seen people that I have gone to bed when I go to Las Vegas, and when I get up in the morning, they're still in the same seat, putting their money away. I mean, it's so sad. But I mean, isn't that what we're doing if we're playing with the stock market? It's not guaranteed. I mean, how many people, anybody here from the airlines? Nobody here? We usually get one or two. But talk to a pilot or a flight attendant from a United. They used to be the friendly skies. When you go to their counter, they're not friendly anymore because they lost everything. So, besides losing money, you're losing time with the stock market. If the market declines by what's on the red right here, let's say that it drops because President Trump gets impeached, and the market drops to 50%. The market has to do 100% just to get you back to even. Not to make any money, just to get you back to where you were before you lost the money. Now, if you are in your retirement years, think about it. What impact that would have on your income? I mean, when do you think the market did 100%? I'm going to give you a clue. Never. So besides losing time, you're losing what? Money. So do you feel that it's really necessary today to protect ourselves from those Willie Suttons? And Become the Banker is the fort. It is the cannon. It's a very simple program with a very simple formula. You don't have to go to school. You don't have to go to the, and I hate to mention this, but I mean, I have seen this company take advantage of people. The Online Trading Academy. I don't know if anybody here is a student of them, but I mean, they advertise at the same channels that I do. And I have met people in their 60s or 70s that they have paid over $30,000 to learn how to time the market. And if they don't have the money, guess what? They lend it to you at a high interest rate. And you know what? These people are on Social Security. You don't have to pay anything to learn this. It's a very simple program with a very simple formula. It offers a predictable 4%, a 4% tax-free. Is that important to you now? Rate of return. And it will make your money work for you. Let's talk about how it could make your money work for you, because you really wanted to know that. Let me ask you your definition of a bank. A regular bank. What is your definition of a bank? Somebody who? Who said that? Speak up. Somebody that holds your money. That is right. That is the only thing they are. They're a holding pool. It's a pool of money. That's all a bank is. They don't make any products there, do they? Even though they give you coffee and donuts on a Saturday like this, they don't make them there. If you open up a checking account, they'll give you a toaster, right? Or an iPod, but they don't make them there, right? So a bank is nothing more than just a what? A pool of money, a warehouse of money. So what happens when water, and I'm going to make this analogy, when water stops flowing? Stagnates. Becomes putrid, right? So you want to know why banks make a lot of money? They use the principle of, you may want to take this down, this is critical, the flow of money. Just like water, in order for your money to work for you, sir, money has to flow. It has to flow. It has to flow. Does that make sense? It has to flow for your money to work for you, to make money. There's only one job that your money has, is to make money. So, what happens when you deposit your money at the local bank? What happens to that flow of money for you? Now let me tell you something. In the old days, you used to take your paycheck, am I right, to the bank? You give that to the teller, and they gave you a what? A receipt, a piece of paper. Technically, your money has actually stopped flowing right there. Make sense? Now, today, we have a lot of convenience. You don't even have to go to the bank to deposit your money. It's done electronically. But your money still is going to stagnate. Now, what does the banker will do with your money? No, not invest it. What are they going to do with your money? They're going to lend it. Somebody will come to their bank and, hey, I want to get a car. Oh, we'll give you a loan, right? They're going to lend your money, right? That's what they call money flow. They're going to charge interest rate, right? Then the person pays them off, and then they're going to lend it again. And they lend money over and over and over again. That's why banking controls the money supply of this country. They use the money flow principle. Money has to flow. Okay. If you're the banker, you can do the same thing. So just take a look at this right here. In order for you to become your own banker, in order for you to become a bank, like the wealthy people have done in the past, you have to create a pool of money away, put this down, away from the bank. You don't want to have a pool of money in the bank because you're defeating the purpose, right? So you have to find another vehicle to build an independent pool of money. They can call your pool of money. We have that product, by the way. That's the heart. That is the engine of the Become the Banker strategy. This product, and you probably know about it already, is under Section 7702 of the Internal Revenue Code. So it's been approved already by the government to put your money away from the banks. Section 7702. So, when you deposit money into your own pool, this is your own pool of money now. You're creating your own bank. You're going to be getting a 4% guaranteed rate of return, tax-free. You can take your money out liquid with no penalties, unlike a 401k, and it's safer than a bank. Based on that, would you have any problems putting money there? All right, so what happens when you need to finance a car or anything? Once you build up your pool of money, right? You take a loan against your pool of money. You see, not the bank. You take a loan against your pool of money and you borrow it. Now, would you check your own credit? No, I'm being frank. Would you? No, you don't. You wouldn't have to, right? Okay, so what happens when you borrow money from a bank? They'll check your credit, right? They'll humiliate you, just like Paula. They'll deny your loans. When you're the banker, right here, you're not going to check your own credit. With the bank down the street, they will create a payment plan, right? Over 4 years, 3 years, and you have to keep it. What happens if you miss a payment or 2 or 3? What are they going to do? Repo. They're going to ruin your credit, right? What happens if you are the banker, you have your own pool of money, and you make a contract with yourself that you're going to pay off the loan in 3 years, but something happens that you lose your job and you can't make the payments? Would you repossess your own purchase? I mean, this is hilarious, right? But I mean, it is what it is. You wouldn't do that. All you do is extend the terms, you see, giving you total financial freedom. You don't have to worry about it. So when you make your payments back to your pool of money, you're in essence paying yourself back. So we want you to pay yourself back at the same rate that you would have paid another bank. Don't cheat yourselves. Remember that? All right. No credit checks on loans, no fees, and you do it on your own terms and you get the money tax-free. How good is that? All right. So what is this pool of money that I'm talking about? Some people have, some people may not have it already. It's a product that has been around for over 200 years. It is the only tax-free vehicle, totally tax-free. And that's the only reason why we're using it to build a pool of money. It's been around for 200 years. It's based on tax law. It's guaranteed to be safe. It will give you the 4% guaranteed, nothing to do with the market. It's not going to go up or down. No stock market danger, and you can have access to your money. So this pool of money, what is it? Do you believe in conventional wisdom anymore after today? Conventional wisdom is what taught you to look for the lowest rate on a loan. Conventional wisdom taught you to look for the highest rate of return on an investment, and I think we have discredited that, haven't we? So I want you to disregard your thoughts about this product right now, because it's probably wrong. The product is a unique and very powerful life insurance product. It is not the type of life insurance that you have. I can tell you that right now. It is not the type of life insurance that you probably have heard about. This life insurance policy was created specifically to act like a bank. So I'm going to quiz you one time right here. Why do you think we're using life insurance for this wonderful strategy? What?
If I die for my child.
Yeah, no. Don't even think. People don't buy it because of the death benefit. This is totally different. Okay, I want you to. Why would we use life insurance? Real simple. 2 words. Tax what? Free. That is the only reason why. We minimize death benefit. It's not as important for this strategy, and we maximize the growth inside the policy for cash. Now, why do we use that again? Because it's tax-free, number one. Number two, you can access your money with no penalties. You don't have to die, by the way. This is a living policy. Okay? And you'll see some examples here. Does that make sense? All right. But I want to tell you something, that not all policies are created equal. If you went to State Farm, the New York Life, Allstate, Farmers, any other company, and you say, I have $300 a month, I want to buy life insurance. You know what they're going to give you? A policy that looks like that. A huge, what? Death benefit and very little access to liquid cash. And I agree with you. Most people, when they see that, they'll say, I don't like that, because I have to die for the policy to pay. You see? Why do they do that? Well, the agent makes commissions of the death benefit. The company makes their fees and expenses from the death benefit. So this is what Tom Martino calls a company-driven policy. That means that it's for the benefit of the agent and the company. I don't like that design. I'm 100% with the rest of you, because people have to die for the policy to pay. The Become the Banker policy for the same premium looks like that. You still have to have what? A death benefit to call it life insurance and keep it tax-free, but the majority of your money is where? Available at 4%, easy to use, and tax-free. Now the people who work with us, we make less money than somebody that works with another company here.
Sorry.
No, sir. Does that make sense right here? All right. So, those of you that have actually heard Tom Martino, You know, he actually has studied this for over 20 years because he became my client over 20 years ago. And he wouldn't be talking about it unless he knew it was absolutely on target. So let's see what he has to say.
Help, information, referrals. I'm consumer advocate Tom Martino. Did you know the stock market averaged less than 3% in the past 15 years? And that's before taxes. But there is a safe, reliable alternative.
It's the only vehicle that we know that is totally tax-free.
You see, the government allows us to overfund life insurance to accumulate cash value tax-free. It's one of the last great tax shelters for retirement.
And you'll get paychecks for the rest of your life, tax-free.
Joseph Chiano and his son are not your typical life insurance salesman. In fact, they downplay the insurance part of their
You
business.
put money into this life insurance policy, not because you're buying life insurance. You're doing it to create wealth.
And the amount of wealth is up to you. You can pay premiums as little as $200 a month or deposit big sums of cash. It's totally flexible. But remember, the goal is to get the smallest amount of insurance with the biggest premiums so you can build big cash values tax-free.
It's not about the life insurance. Like a lot of people have said, that death benefit is the frosting on the cake.
The Chianos call their life insurance investment strategy Become the Banker because you can borrow from your policy for cars, college, or anything.
You are going to be making the interest that the bank would have made on it.
So by paying interest to yourself, you're actually putting that money away.
Absolutely, for your own retirement. Isn't that beautiful?
Are you getting all of this? If you become the banker, you can grow guaranteed wealth tax-free. Forget the stock market. Borrow from yourself. Pay yourself interest instead of banks, which shelters even more of your money. And finally, get tax-free retirement paychecks for life.
What do you think? Another way to look at what? Life insurance, right? Yeah, can you hold our questions till the end, please? Thank you. All right. So let's look at this here, but the people who have used it. And I think we actually talked about it during the film. But you know, Walt Disney, J.C. Penney, the ex-President Ford, even the ex-chairman of the Federal Reserve, Ben Bernanke, who controlled the money supply of this country, uses the Become the Banker strategy. John McCain, and I'm sorry to hear that he's stopping his treatment for his brain cancer, he has the Become the Banker policy. All the politicians have it, all the wealthy people have had it. All these people right here that you see, all the men, were wealthy at one point before they started. The lady that you see right here, I am so proud of her. This lady was not wealthy. She bought a very small Become the Banker policy many years ago, and it helped her put her company on the map, just like Paula's husband with Crunch. 2 years ago, she sold her company to Warren Buffett for $2 billion. And she was interviewed by CNN saying that if it wouldn't have been for her tiny little life insurance policy that she bought many years ago, never would have happened. Doris Christopher was the founder of Pampered Chef. Pampered Chef, yeah. Now Warren Buffett owns it. Just like Paula's husband, Crunch is in 4,000 locations right now. Now, anybody here from Colorado, by the way? Born and raised?
Yeah.
All right, let me ask you this. Have you heard of the Betcher family? The Betchers? You have? You haven't? Who has? Okay, the Betcher family, sir. Do you think they're wealthy? Yes. They're multi-billionaires. They have the Betcher Foundation, the Betcher Hall, right? They give the Betcher scholarships, on and on and on. Who can tell me what happened in 1929? I know that you weren't there, but just tell me what happened from your readings.
Stock market crash.
The stock market crashed, right? It went to its knees. Most people need to have a car. Am I right? So we're going to use that as an example, a car. But it could be used for college, could be used for a home, could be used for anything. So let's take a look at that car. $50,000 for that car. Let's look at the terms. 7 years. 84 payments. How about 8.5 APR? Doesn't matter. Okay. And what about the payment, the monthly payment? I see some people here right now that are saying, oh my gosh, this is, terrible. Right? Let's play this game real quickly here. Take your hands. On the right hand, I want you to have a baseball cap. An imaginary baseball cap. On the other one, oh, you got one. I know, you just put that on your right hand. That's a good one. Okay, and then on the left hand, I want you to have a banker's hat. Like the Monopoly banker's hat. All right. I want you to put that consumer's hat first. And tell me what you think of those terms. I'll say consumer. Huh? Terrible, right? High interest rate, high payment, too many years to pay on that car. Now take off that hat and put your banker's hat on. What would you say?
Great deal.
Now you're catching on. Now you're catching on. Okay, I want you to start thinking like a banker now. Okay? Now look at this. The options to finance that car are two. Either you go to Wells Fargo down the street, or you become the banker life insurance bank. Okay? So let's look at it on a monthly payment basis. If you finance the car through Wells Fargo here, the monthly payment is going to go where? Every month. Where are you going to send it? It's going to go like that. Am I right? Would you ever get the money back? I've been financing cars all my life, and I have yet to have a bank send me any money back. But if you were to take a policy loan from yourself, your own personal bank, from your life insurance policy here, and you send the same payment, where would it go? Back to who? Exactly. So the interest rate that you were paying is going to make your pool of money grow even faster. So let's look at it at the end. I love bottom lines, okay? At the end of 7 years, under both methods, the Wells Fargo method and the Become the Banker method, do you agree that you still have a car? But it's depreciated, right? It's no longer worth $50,000. It's probably worth about $10,500. Under both methods, this is how much you pay for the car. There was a $50,000 car, but you ended up paying how much? How did we figure that out? Well, there's the principal, and that's the interest. Now, if you become your own banker and you pay yourselves back, you recapture that, you see? You don't lose that. You would recapture that. That would have gone to the other bank. But because you took it from your pool of money and you paid yourself back, you recapture the principal and the interest. And guess what? You still have what? The car. Now look at the numbers. Now, which one would you rather have? Only the car or the car and the money? And that happens with everything. Isn't that exciting? All right. We're going to go to your questions here shortly, but this is probably the most important slide. This is your bucket of money in the life insurance policy. And when you're thinking about creating a pool of money, don't even think about the death benefit. It's there, but it's just like a frosting on the cake. Okay? I want you to think about how much money can you put in, how much can you pay yourselves money, what percentage of your income can you put into that life insurance policy pool of money that you can use tomorrow. You don't have to wait 10 years, tomorrow. Okay? So if people have money laying around that is now working for them, like at a bank, they can put a lump sum, just transfer the money into that pool of money of the life insurance, and they can also make monthly or yearly contributions to it. The more you put in, the better it works, just like anything else. And I'll show you an illustration. So let's say that you built it up to $20,000 and you want to buy something for $10,000. Where do you think that $10,000 will come from? That's wrong. That's what most people think. Okay, I want you to look what the statement says right here. Your what? Your money. It stays where? Okay, where do you think the money comes from? It's not your policy. It comes from the life insurance company pool of money. It doesn't come from your account. It comes from the life insurance company. See, life insurance companies have a general account, and they make money accessible to policy owners. It's called a policy loan. They're going to give you a loan against what? Your policy. So if you borrow $10,000 from the company, they're going to put a lien of $10,000 against what? Your 20, right? But your 20 is still inside your policy, growing at 4%, tax-free, and making money for you, even though you borrow against it from the company. Is that making sense? Yeah. All right. So the company will give you a loan, and are they going to do it for free, you think? No, they're not going to do it for free, but don't worry about paying interest to the company, because the companies that we use are mutual companies, and the more money they make, you get dividends, which are the profits of the company, which are in addition to the 4%. Dividends are not guaranteed. They could go up and down. The 4% will always be guaranteed. But if everybody pays their interest, the borrows money, then the company makes more money and they give you a bigger dividend. All right, so let's say that you, and oh, by the way, the interest rate that they charge, it's 4.76%. Write that down. 4.76%. But look what's on the green right here. Simple interest. This is not like a mortgage. This is not like a credit card. This is not like an automobile loan. Simple interest means that it's not compounding. Give you an example. If you were to borrow $1,000 from the company at 4.76%, you would only pay them $47 for the entire year. For the entire year. Then when the balance of the loan goes down to $900, you pay 4.76 on that $900, you see? And then $800, then $700. See, it doesn't compound like a mortgage. So that's what I want you to keep in mind. On the other hand, your $20,000, your entire $20,000 is earning what? 4%. Plus dividends, compounding. This is what you want. You want that to compound. So if the company is charging 4.76%, wouldn't it be wise to pay yourself what we're paying Visa? 14%, let's say. So the first 4.76 will go to the company, right? And the other balance will go where? Back to you, because now you're creating more money. It's making your money work for you. Does that make sense? All right. So let's go through. Randy's, we're going to show you some illustration now so you can see. This is just an example. He's age 40, non-tobacco, so he doesn't smoke. And he wants to put $10,000 a year because he understands that it's not about the death benefit. It's about accumulating wealth. So he wants to put $10,000 a year, but he doesn't want to contribute for the rest of his life. This policy, you can stop contributing in 2 years. Or you can actually contribute for 7 years. Or you can contribute till you're 90. It doesn't matter. You choose the terms, okay? So this person said, I want to be done contributing when I'm 47. So I'm only going to contribute 7 years. So take a look at one thing right here. The first year he puts how much money? Go all the way to the right was his net cash value. That's the pool of money that he has available to borrow. How much can he borrow? Almost $8,400, right? Now, stop right here. He puts $10,000 in today. He can take out $8,400 tomorrow. Tax-free. Now, if he had a $5,000 balance on his Visa, paying 30%, wouldn't it make sense to take a policy loan against that? For $5,000, pay off Visa, write him a check and say goodbye, and then pay yourself back up to 30%. That's what I'm talking about. Now I want you to follow along with me. I'm not going to go line by line, but I want you to see what happens in 7 years. At the end of 7 years, he put the last payment in of $10,000. How much does he have available to borrow? Almost $71,000. So stop right here again, please. He gave us how much money in 7 years? 70,000, right? And he can have access to what? More than what he put in. So tell me a real simple question here. I'm going to ask you to give me the answer to. How much is the life insurance costing him? Huh? Zero. He's making money. See, this is totally the reverse from any other company, right? Now, look at this column right here, loan. Beginning on the 8th year, he says, I want to start taking out $10,000 every 3 years. And I'm going to pay myself back. You see that 3,600 right here? I want to pay myself back $300 a month. So he wants to take out $10,000 to buy a car. Pays them off. Then he takes another one, pays it off, takes another one, pays it off. He goes through life using his money and paying himself back, right? And then at the end, at the age of 65, how much cash does he have on that column? How much? Almost $138,000. And how much money did he give us?
70.
Is that a good rate of return?
Yes.
Now, don't forget, now, once you go all the way to the top, Randy, please. Don't forget that we have another column that we haven't talked about, which is the icing on the cake. See the death benefit column right here? Let's say the year number 1, he puts $10,000 in. But he didn't take out any money. Then he dies. How much is the company going to give his family? Right here, $253,000. Now, think of the difference. If you have $10,000 sitting at a bank account, at the local bank, and you were to pass away tomorrow, what is the banker going to give your family? Just what you have in there, right? Now, if you go down to age 65, he has $137,000, and he still has over $252,000 of death benefit. Tax-free. We're going to put it down, Randy, please. Beginning at age 66, you see that $10,000 coming out every year? That's what I'm talking about, paychecks for the rest of your life. That means that this policy could give you an income, a tax-free income for the rest of your life. So here's the points. You have access to your money throughout your life to do your own financing and paying yourself back. If you were to pass away, you have the protection of the tax-free death benefit. And then at the end, you can take an income, tax-free income for the rest of your life. Now, you see why the wealthy done this before? But you don't have to be wealthy to do this. You can do it at any amount that you feel comfortable. All right, Randy, let's go to the PowerPoint one more time, and then I know I didn't give it to you on your handouts, but I love it. Have you ever seen those birds on a power line?
Yeah.
2 of them are laughing because one of them is falling down. And they're saying, you're overthinking this, Phil. And so it is with this. I mean, this is life insurance. It's been proven. It's been around for 300 years. The wealthy have used it. It survived all the wars, the depressions, and all that. So it's not really rocket science. And I want to just remind you that I want you to please complete the form. Give it to us because we want to find out if this is really going to be beneficial for you. Because what you do today, if you don't do anything today, nothing will change. I can tell you that right now. Like, what is the definition of insanity? And expecting a different result, right? It's not going to happen. So what you do today will determine, listen to me carefully, will determine where you're going to be 5 to 10 years from now financially. We have had people that have seen us for the last 10 years that are finally coming in and they're saying, I wish I would have done it then. So you can either schedule the consultation now or you can just give us the form. Now, we want you to stay financially up to date. We do have an electronic app, and you can download it to your phone. All you got to do is actually text "Become the Banker," no spaces, lowercase, to that number, 36260. And you'll get an app that looks like that. Now, I'm going to tell you something about this. We cannot pull it up, but I'm going to tell you something right now. When you download it, you will have access to over $100,000 of financial resources at no cost to you. It's what they call, and you'll see it, it's called free financial resources in there. It's on our website too. But it's phenomenal. We had a client that he bought the policy to become his own banker, but his wife passed away. So we settled a death claim, but he went online and he downloaded the guide, What Happens When a Loved One Dies. That's the title of what he wanted to. But we have What Happens When a Child Goes to College, What's a Divorce. We got $100,000 of excellent financial information that is at your fingertips. So download the app by simply texting "Become the Banker," all lowercase, no spaces, to that number, and you'll have access not only to that, but also to see the next seminars coming up, or to refer us to somebody else if you like what you heard today, or to just basically give us a good review. Fair enough? All right, so I'd like to open this up for questions right now.
How much is the consultation?
There's no consultation at all. There's no fee. We don't charge anything. See, if you decide to do business with us, the way we get compensated is by the life insurance company. You guys don't pay us anything, which is really good. Yes, sir.
Maybe in the future, the government will change that regulation on life insurance.
Yes, they might. It's happened already a couple of times, okay? In the 1980s, before the 1980s, you could actually put $50,000 single premium into a life insurance policy with $5,000 of death benefit. They caught on to that. Now they say you have to have so much life insurance, and you cannot just put a single premium. You have to put contributions. But we met a lady here, actually, that bought a policy in the 1970s. She put $50,000 in. That's it, single premium. Her policy right now is worth over $500,000 tax-free. You know what she said to us? Can I buy another one? It's too late. They can't. They changed the rules, right? So yes, they can certainly change the rules, but they're not going to go backwards. They're going to go forward. So anybody that buys the policy the way it is today, like the lady, will remain intact. Grandfather, that's right. So it will be worth its weight in gold if they do change that. Just like the lady said, can I buy another one? Now, a lot of people, what they say, well, this is life insurance. What if I'm past the age of qualifying for life insurance, or maybe my health is not good enough? Don't worry about that. This is different. Don't worry about that. You know why? You can put the insurance on somebody who's healthy or younger. Just like my 6 children that I have, I put the insurance on them. I'm the owner. See, I own the policy. I put the money into the policy, right? They have the insurance. Now, I have 6 kids, so basically I have 6 banks. So I can go to each one of them and take out money, you see what I mean? And then put it back in. I can do the banking function without having to have the insurance on me. You can put the insurance on your children, your spouse, anybody that you're related to that is a blood relation. Or if you're a business person, you can put it on a partner as well.
Do we do a physical?
You do have to have a physical, yes. Well, it just depends on the amount that you want to put in, but they do give you, but the company will pay for it. So, but like I said, if something happens that you can't qualify, then you can put it on somebody else. And you can still use the money.
Is there an age limit?
The age limit is 85.
Wow.
Yeah. We have different products for that, so. Yes, sir.
So it's just only as good as this company?
You want to know something? A good question is that it's only, it probably is. I'm going to tell you why. Okay, there's a lot of, we use actually 5 companies. We have 5 companies. One of them is that one, okay? But all the companies that tend to do this are the mid-sized companies. We choose them by their strength financially, and we choose them by their age. This company was born in 1904. So, I mean, they're over 100 years old, and they're very strong financially. Now, but they're not a giant. They're not a New York Life. They're not a Prudential. Those companies don't want to do this because it costs them money. Okay, companies like this are mid-sized companies that they have to do something different to capture their market share. So that's why we use those companies.
But if this company goes bankrupt, there's no guarantee you're not.
Oh, no. Good question. Let me just say this to you, that in my 44 years that I've been with this industry, I have never seen a company go bankrupt. There's a lot of safety. When you're dealing with life insurance, there's a lot of safety nets, okay? For example, every state has what they call an insurance department. Ours right here in Denver is on Broadway, and it's regulated under DORA, which is the Department of Regulatory Agencies, okay? So this is what happens. First of all, life insurance companies, they have to follow a very stringent investment model. They cannot invest in the stock market. They're forbidden to do that. They cannot go to the commissioner saying, well, we can't pay the death claim because the market was down. It doesn't happen like that, okay? So their main investments are based on bonds, high-grade bonds, investment-grade bonds, commercial real estate mortgages like malls, shopping centers, and they have, the balance is actually cash, just liquid cash, okay? So if they have bonds, they've been buying bonds for over 100 years. So some of them are coming due, right? They buy some more, they're laddered. So they're not getting a huge return, you know, so they're probably getting maybe 10 to 12 and they're giving you 4. So they're very secure. However, though, just to carry that forward, if they do have any financial difficulties, if they do, the state of Colorado will walk into their home office and run the company until they find another company to merge the company with. It's what they call a merger. And the new company has to keep their promises that the old company made in order for the merger to go through. Cash value and death benefit. So, and then the last safety net, every state has a pool of money. It's a guaranteed pool of money. They charge every life insurance company a 3% premium tax to do business in the state. So they're saving this premium tax into a pool of money. It's called a guaranteed association that will actually guarantee your money. So, yes, I have never seen a company go bankrupt. And if they do have any financial difficulties, I feel safe saying to you that you're not going to lose anything. Yes, sir. By the way, did that answer your question?
Yes.
Okay. You bet.
I came late a little bit, but what are you a banker? Are you an advisor? How it's work? I don't know. Do you have any definitions about how it works?
Say that again, please.
Are you a banker?
Am I a banker?
Yes.
No. What am I?
Banker or what?
I'm a certified financial planner.
To advise?
I am a yes. Yes. Yep. Good. Anybody else? Did I do such a good job that there's no questions? Oh my gosh, I mean thank you so much. Well, the next step will be, to do something differently, So why don't you go ahead and, yes.
You're not that good.
Oh, okay, no, I'm not done. Go ahead.
So on the sheet that you showed.
Yes.
So that first year you put in $10,000.
Yes,
The net cash value, $83.78.
yes.
Where's the rest of that?
What's beautiful question. Everybody understand that?
No, I didn't hear it.
The first year he puts $10,000 in. But the net cash value that he can borrow is, let's call it $8,400. So where the other $1,600 went? That's right. They went to pay for the insurance. See? Yeah, well, he went to pay for the insurance. Now, do me a favor, go down to 7 years. How much did he put in total? How much does he have available? So how much is insurance costing him now? Okay. See, so these policies are unique, you know, the cost of insurance goes down.
So you kind of got to go to that 7th year before you really.
It depends. This person did. It depends. If somebody puts a lot more money in, it could be in 2 years or 3 years. I mean, they're very, very flexible. They're unique. It's a unique policy. You're not going to find that any place else. It has to be designed properly.
So does that mean if you put smaller amounts in for those first 7 years, it will take longer?
It would take a little bit longer, yeah.
To start making money?
Yep. Well, you can almost, yeah, but you still have access to your money though. Because see, if you put 10,000, even though you're giving the company $1,600 for the life insurance, you still have access to $8,400. I mean, if you were to go to Prudential and say, I want to put $10,000, can I have access to my money day one? They'll say, no, you have to wait 1, 0, 2, 0, 3. They have to wait 4 or 5 years before they can give you any cash back. This is a totally different animal. I mean, look at it as a Ferrari. I mean, if you were to get a Ferrari, you wouldn't put regular gasoline, right? I know you wouldn't do that. I mean, so this is the Ferrari of the life insurance, you know, policies. Put as much as you can. It's for your benefit. You're not going to lose it. Yes, ma'am.
What's the minimum you expect?
Depends on your age, okay? Because some people, you know, if they're young, you know, they can actually get away with $100 a month. You know, but people that have lost time, they need to pay themselves a little bit more, right? You know, as a financial planner, we have a rule of thumb that the average person should pay themselves 10%. But if you're a little bit older, you may want to bump it up to 20 or 25% because you lost time already, see? So to answer your question, $200 is pretty much the minimum. You know, if you're an adult, it may be $50 to $100 if you're a youngster. A month, yes. Right, it has to be either a month, but I mean, again, like I want to mention this to you, if you have any money that is not working for you, just laying around, this is the perfect place to put it as a lump sum. See, and then you can start using it. Yes, ma'am.
Does the IRS code allow you to move money from an existing IRA?
Oh, great question. No. I tell you, because see, the government would lose out on taxes, and you think they're willing to do that? They're not going to allow you to take money from a 401k or IRA that they haven't collected money from and put that into a tax-free vehicle like this. So, but if you do have how many of you have a 401k from a previous employer? A previous employer. Okay. An IRA from a previous, okay. If you have that, we have other programs. Okay, it cannot be this. We have other solutions that are totally safe and you can make money on. Okay, so we can talk about it when you come in. But I mean, that's a totally different thing. So I'm sorry to tell you that it doesn't work, but if you have an existing IRA or an old IRA or a 401k, we can help you move the money into a safer place. Okay, but it will be taxable, always. Yeah.
Now, one of the slides said something about there being
Yeah, that's for an IRA, not this.
I'm talking about for the 401k, where you get access to
Yes.
59.5.
Yeah, there's no penalty. There's no penalty after age 59 and a half, but there's still a tax. Yeah, right. Right. You can pull out whatever you can, yeah, but still pay the tax. You can do whatever you want. You got it. Anybody else? All right, we see we're going to do the drawing here then. We're going to do a drawing. I tell you what, we have some phenomenal gifts for you. So I'm glad that you stayed around, okay? Besides the knowledge, we're going to get you something else. So what is the first one?
The Y factor.
And where's the little thing?
They're right there.
Okay. All right. You want to do me a favor and draw a number? And just read the last four.
7965.
7965. Right there. All right, so this is, I'm going to tell you something, young man. This is the first book I wrote. It's called The Why Factor. Okay, so take care and read it and let me know what you think, okay?
All right, thank you.
You bet. Next one.
7970.
7970. There it is. Which one's that? Become the Banker. Okay, good job. Those are the two best-selling books that we have, by the way. And the third one that we're going to give away, it's pretty close to it right now. It's called Smart Money Moves. And go ahead.
7951.
Hey, all right. Well, this is good too. You're going to like this. Congratulations. And those of you that didn't win a book, you can always get them on our website. Now we had a special on TV, right?
Yes.
We had the series of three of them, for I think it was like $40 for all three. Normally they're $60 for the three. So if you want to purchase them, you can. We have them here, or you can just go to our website. Okay. Don't forget to give us the sheet, and I really enjoyed being with you today.
Thank you.
My pleasure.
Yeah, I think we're gonna set up an appointment with him to talk to him, so get a little further on in our life. We haven't, as with everybody, we have a little bit of savings in an IRA and a 401k, but not enough probably for when we retire, so that's my husband right here, so yes.
A different way of investing in your future.
The funny thing is, I actually sold life insurance for 2 years and never knew anything about this type of policy.
Perfect kidding, huh?
Very interesting, yes. Very, very interesting.
Thank you so much.
Thank you.
I definitely left our numbers for him to call, so to see what we can do with some retirement money.
Well, one thing is that, just another option, another
Bucket.
bucket, another basket to put your egg in, or egg in, whatever. But yeah, just kind of like a new way of looking at things, and
Yeah,
kind of another option.
yeah. Financial freedom.
Perfect. Thank you so much.
Thank you.
Very knowledgeable. I am going to come see him and get all the particulars and everything because I have a lot of questions, but yeah.
So there were many things that you knew before or really new?
I knew nothing. I knew nothing about this. I had no idea it would be a life insurance company. I probably wouldn't have came if I did. But yeah, we're gonna get some more information and see if it fits for us.
Perfect. Thank you, sir.
You're welcome.